Have you ever heard the term money laundering and wondered what it means? It often comes up in crime stories, news reports, or financial scandals. In simple terms, money laundering is the process of making illegally earned money look legal so it can be used without raising suspicion. When criminals earn money from illegal activities like drug trafficking, corruption, or fraud, they cannot just walk into a bank and deposit it. Large amounts of unexplained cash attract attention from authorities. To avoid this, they use money laundering. The goal is to disguise the origin of the money so it appears to come from a legitimate source. Money laundering usually happens in 3 stages. The first stage is placement. This is when illegal money is introduced into the financial system. Criminals may deposit it into banks in smaller amounts, use it to buy assets, or move it through businesses that deal in cash, like restaurants or casinos. The second stage is layering. This is where the money is moved around to make it difficult to trace. It might be transferred between different accounts, sent across borders, or invested in various assets. The idea is to create a complex trail so investigators cannot easily link the money back to the crime. The third stage is integration. By this point, the money re-enters the legitimate economy looking clean. Criminals may use it to buy property, luxury goods, or invest in real businesses. Once integrated, it becomes difficult to distinguish from legally earned money. Why is money laundering dangerous? It allows criminals to enjoy the profits of illegal activities without getting caught. It also fuels further crime, since criminals can keep financing operations. On a larger scale, it harms economies by distorting markets, weakening financial institutions, and discouraging honest investment. In some cases, it even funds terrorism or organized crime networks. Governments and international organizations treat money laundering as a serious threat. Banks and financial institutions are required to monitor transactions, report suspicious activity, and follow strict rules to prevent laundering. Law enforcement agencies cooperate across borders to track down illegal money flows. For ordinary people, money laundering may seem far removed from daily life, but its effects are real. It can lead to higher costs of doing business, unfair competition, and even reduced trust in the financial system. When banks or companies are caught in laundering scandals, the damage often affects employees, customers, and investors. To sum it up, money laundering is the process of making illegal money appear legal. It happens in 3 stages: placement, layering, and integration. It allows criminals to hide the source of their income, harms economies, and supports further illegal activity. Understanding money laundering helps explain why governments take it so seriously, and why financial systems have strict rules to detect it. Thanks for watching, and if you found this explanation useful, remember to like, share, and subscribe for more simple breakdowns of big economic ideas.